It's not a natural nature for you to see your money going down and you to remain calm. That's why one of the things we talk about here is that financial fortitude, right? That ability to stand right in front of the face of adversity, which is right in front of the face of the market going down, right in front of the face of everybody selling it, right in front of the face of everybody saying it's a recession and the market's gonna crash, and we stand firm and say, nope, this is when we buy more. One of the most misunderstood gauges in the stock market is the VIX. That's right. The VIX is important for you as an investor to understand how the market is navigating through volatility. Volatility is the motion or emotion that the market goes through during extreme circumstances. What's good, family? It's your boy, the Wall Street Trap, and today I got a super dope educational video for you for all my new investors that really want to get in the market, who don't understand what volatility is. I'm gonna break down to you right now what's called the VIX gauge. That's right. So right now, before we get into this video, I want you to like, I want you to subscribe. I want you to tell us in the comments if this video was real helpful for you or not, right? This is important for me to give you education that you can truly use and apply on a day-to-day basis that can help make you a better investor, right? So one of the things you're gonna hear all the time on the thing is the VIX. What is the VIX? What is the VIX? What is the VIX? What is the VIX? The VIX is up, the VIX is down. So let's talk about it like this. So if you were a captain on a boat, right? Let's even bring it back a little bit more. You ever heard of the term where it says great captains are made in volatile waters or choppy water, something like that, right? Well, anybody can get in a boat, and while the waters is good, you say, hey, I'm a sailor, I'm a captain. But it's in those choppy waters where the water is just, where the water's going up and down, it's real volatile. You know, people get seasick, people fall overboard, right? A good captain knows how to keep his shipmates, right? His deckhands, and he knows how to keep everybody on the ship calm, and he also knows how to navigate a storm in choppy waters without losing somebody and limiting the damage, because that's a lot that can happen on sea that we don't know about. Well, a great trader or a great investor is made during volatile seasons of the market, right? And one of the ways we gauge how volatile the market is by using the VIX. All right, so on average, the VIX has a range of 14 to 17. So anytime you get on the market and you hear the VIX is at 14 or the VIX is at 17 or the VIX is at 15, you know the market's not good. So let me backtrack a little bit. The VIX goes up when the market is going down. Because when the VIX is going up, there's more people that are scared or fearful. Another thing that'll go up will be the fear and greed index. You'll see the market more in fear as the VIX goes up. So as the VIX goes up, you'll notice that the fear gauge goes up too, because the market is real fearful. Remember, we in those choppy waters, we in those uncertain waters, right? That make a lot of investors do what? Panic sell, and make a lot of traders do what? Get out of the market and get away from the market, right? Now, on the other side of that, the VIX goes down as the market goes up. So the VIX actually moves opposite of the market. Why is that? Because if the market is going up, then there's not a lot of volatility. People aren't being emotional. The sentiment is real cool. Why? Because the market is making money, right? So think about it. When people lose money, or it's not a natural nature for you to see your money going down and you to remain calm. That's why one of the things we talk about here is that financial fortitude, right? That ability to stand right in front of the face of adversity, which is right in front of the face of the market going down, right in front of the face of everybody selling it, right in front of the face of everybody saying it's a recession and the market's gonna crash, and we stand firm and say, nope, this is when we buy more. A lot of people say that, but a lot of people can't do that. Right? Fortunately, you got somebody talking to you right now who's able to do that, and I prove it time and time again. Because I come from the street, y'all, like, I'm not attached to money in the way that most people are, right? And it's just being real because I come from the street, so I understood that you got to take losses. You got to have lawyer money. You got to have bond money. You know, the police might kick your door and you got to flush something down the toilet. You might be running from the police. You got to throw it. You know, you get robbed. You know what I'm saying? You get jacked. You know what I'm saying? Like, all kinds of stuff happen. Your auntie hit your stash. Wait, hold up. I'm talking about my personal business right now. All right, chill. All right, let's get back. Back to regular program. All right, so what I'm saying is because I come from that era, my attachment was, yep, we gonna make money, but I already priced in along the way somewhere I'm gonna get some losses. I'm gonna pay for something that's not gonna be what I thought I paid for. I gotta take that L, deal with it a different way. Like, there's so many losses that come with the game. You already priced that in every day. Well, that's how I'm able to navigate the market a certain way. So I can see my options down and my stocks down. I'm like, it ain't really no big deal. It's part of the game, right? And my stocks go up or whatever. I'm like, all right, cool. Why? It's part of the game. I have more joy from playing the game than I do for the wins and losses of the game. I love the game. I play the game to win, but I love the game itself of the market. And so that's one of the things I'm gonna get y'all on, like understanding the VIX, right? So again, if the VIX is going up, that means the market is going down. That means sentiment is low. People are scared. People are trying to get some cash. So the VIX is gonna go up. Now watch this. Anytime you see the VIX above 17, we are in a high stress situation. Watch this. In August of this year, August 5th of this year, the VIX was at 65. Now, if you put back in your head and you think about what was happening in August, you know the market was bloody, right? So many people were scared and getting out of their money. They was getting whopped over the head. It was like, man, I'm out of here. I can't take this no more. I'm finished. Well, this is the perfect time to position yourself. So if you see this, if I'm gonna give you something, if you see the VIX getting above 21, like 17, 18, that's 5, that's good. You know you're in a high stress. I'm gonna say this, no, not a high stress, watch this. From 17 to 22, you are in a mild stress situation, right? Because this is the normal. So it's kind of like, watch this. So some people, before they are a diabetic, they are a pre-diabetic. So if you're anywhere between the 14 to 17, you good. When you start getting 17 to 21, you are in a mild stress situation. 22 and above, the market done got tense. In the 30s, you got full-on high blood pressure. You on. That's a wrap. No more red meat for you, right? No more fried foods for you, right? You are one bite away, right? So, now watch this. Here's how I'm gonna show you this is a dope situation. August 5th, the VIX was at 65. Watch this. By August 30th, the VIX was at 15. So that means if you bought whatever you bought around this time, you had already made money in 3 weeks. Because from 65 to 15 is a shift. And that means the market slowed down, the market got some news, and the market started turning green. All right, so now what you understand, that's the VIX. Now on the other hand, if the market, so like we talking about a sailor now, a sailor in a boat, a sailor, you're in a sailor on a ship. This is when you become a great investor or trader. Anybody can make money here. Now, don't get me wrong, I'm not gonna take nothing from you, but this is a stable market. I'm gonna rephrase that because you still can lose money. You have a better chance if you just a new investor. This is what you wanna be at. You like it here, right? You got a little 1% pullback here and there. The market still, the VIX is not up, it's okay. But once you pass 22, that's when you start feeling a little pressure. Once you get to the 30s and the 40s, you like, yo, I don't want to do this. But what you need to be doing in this area, once it passed 22, you need to be like, oh, this is my time to shine. This is when you buy the options contract. This is when you buy the day trade. This is when you put your puts in. This is when you buy your inverse ETFs. This is a prime time for you. So you looking like, Trap, like I don't really know when to buy. When should I buy it, Trap? You're going to find your best deals when the market goes past, when that VIX goes past 22. So when that VIX goes past 22, I need you to lock in low, right? Now, here's the thing. If the VIX is over 14, if the VIX is anywhere in this area, you can find some deals. If the VIX goes, watch this. If the VIX goes under 13, everything running hot. Everything running hot. 80% of the market running hot. So the VIX get, 13, everything running hot. It's a day trade. It's a sweet day trader market, right? If the VIX is at 15, 16, 15, it's lukewarm, right? It's lukewarm, and so you got some pockets that you can go sit in and see what it is, right? You may have some sales. Anything 17 up, you know one thing. 17, 18, 19, 20, you see it happening. 22, hey, load up. Now, I'm going to tell you something. You get to 22 to 30, it's easy for you here to start buying positions. Now, from 22 to 30, now, what if you go to 40? Well, that means you're going to double down. Right around 36, 37. You buy some more. You buy some more. Because watch this. Let's go back to an old video. Is it a company event? Is it a stock market event? Is it an industry event? But watch this. If the VIX is moving, that means it's a stock. If the VIX is going down, up, that means it's a stock market event. And, that's good for y'all. So a lot of things in the market is on sale, right? If the VIX is going up, that means it's a stock market event that's happening. So if you see something at 14, 13, 12, 11, sharp. Like, the market is, this the market where everybody gonna get on here and start saying they brilliant, right? But and I'm not mad at that because you making money out the market. But when you start getting in that 65, so let's talk about the VIX again. The VIX is a volatility gauge that measures where the sentiment at in the market. On average, the VIX is going between 14 and 17, right? If the VIX goes above 22, you are in that pre-diabetic stage. Nothing against my previous unit example. Anything above 22, you hitting buy zone, and you need to start putting price points together. The higher the VIX goes, the more you're supposed to be putting money on the side to be liquid. Anything under 14 and under, I'm not telling you to buy nothing, but you should already be in position for the market start running, man. So, man, I hope y'all understand the VIX right here, man. It's your boy, the Wall Street Trapper. Make sure you like, make sure you subscribe. Make sure you tell us in the comment how you feel about it. Also, make sure you tap into our show each and every Tuesday called Trapping Tuesdays, man. And remember, that is not me in the chat telling you that here go my WhatsApp, here goes my coach. That ain't me, man. Don't fall for it, man. It's your boy, the Wall Street Trapper. Hit that like button, man. Salute.